Joining me here at the Beaver Creek Precious Metal Summit, I've got Anthony Milewski from the Oregon Group. Anthony, thanks for joining us.
Thanks for having me. It's always great to catch up. And finally, we're doing it in person. You know, it's always on the internet when we're talking. So.
Yeah. Let's start off with, you're a guy who has been involved with a lot of different commodities and deals. I believe Bloomberg once dubbed you Cobalt Jesus.
That's a different life, but yeah, that happened.
So tell me, what's the buzz here at the conference when you're talking with various people in the industry? What are you hearing?
Yeah, so I mean, first of all, I'll tell you right off the bat, I'm not a tinfoil hat, like doomer prepper guy, but notwithstanding that, I mean, gold and silver look interesting for the first time on memory for me. You know, one of the things I look at, so when you think about gold and what's happened, you have this price now sitting at $2,500, right? And you have all this buying from central banks. You have the Chinese central bank, the Russian central bank buying. Up until the last few weeks, you've actually had outflows in gold bullion ETFs. So that's really weird because historically, when you have a big gold price move, you have inflows into these bullion ETFs. And that's part of the driver. It's not, you know, jewelry in India, for instance. And we've had the exact opposite. And this is so bullish because what that means is to date, that drive has really been from these central bank buying. And now for the first time in forever, you've got all of a sudden a reversal. You have inflows into bullion ETFs, and it kind of signals to me the potential for gold just on those fundamentals to go higher, which once again, that's going to translate, I think, into a potentially big move in equities. So that's something that's kind of exciting. We're in a space that's not been interesting for years.
Yeah, so effectively what we have is we've got these central banks, they're buying up gold, but ETFs, we can kind of view that as sort of a proxy for retail investors. They haven't bought into the narrative yet, but as the price continues to go and we haven't seen that rocket fuel kick in yet,
Well, I mean, what it seems to indicate to me is, this move to 2,500 has been fueled by macro conditions, right? Yeah. By a global climate around these wars and all this stuff going on in Russia and Taiwan. Now, what we haven't seen is Billy the plumber buy into that, but all of a sudden we've seen a shift. And so it tells me that gold could go up to 3,500 or something, some astronomical number. And then what will happen is that gold price will then get rerun through everybody's model at these equities and these gold companies. And the NPV of these gold companies will explode on paper and potentially translate into big equity gains.
So Anthony, earlier, I'm not going to name the CEO, but we chatted with a CEO of a junior company, little 20-cent company in the precious metal space. And he was talking about his company, talking about the industry, positive hat. And then we get off camera and he's just like, the junior mining space doesn't make any sense. I don't know why anybody would invest in it. And it just seemed, and you can just tell.
Did you hot mic him? I mean,
possibly. Keep tabs on that guy. But what I find interesting about it is it's like he's been in the space for so long, basically banging his head against the wall, struggling to raise money and seeing his share price really never go up. And I think that something I always enjoy about talking with you about is this whole sort of macro theme of how you make money as an investor in this space. And I think sometimes people, they get so caught up in the details and the day-to-day that they lose that sort of macro focus of how to make money in mining. And I know you recently did an article about this. What can you tell us about your way of making money in mining? And if, say, a young person came to you and said, Anthony, how do I make money investing in junior mining? What would you tell them?
Well, first of all, you better get lucky, right? Like it's better to be lucky than good. But I mean, jokes aside, I don't know what story you're talking about, but actually the asset really matters. And the assets that I like in particular ahead of a commodity move are these large out of the money call options, because they trade at almost nothing. Through the cycle, they'll trade at almost nothing. But then if you have a gold price move from 1,500 to 2,500, in the example we're at Beaver Creek, an asset that had a $1,700 gold price to work is basically worth zero at $1,500 gold, and it will trade as such, right? It will trade with a $5 million market cap. Now you're at $2,500. They could have a $200, $300 million market cap. And you can extrapolate that strategy across almost any commodity. If you look around the world, we've been exploring for minerals at a pretty steady pace, actually, for the last 100 years, say. And so there are large copper deposits. There are large gold deposits which are undeveloped because last cycle's low grade is next cycle's high grade. Mm-hmm. And I really believe that. And so for me, when I think about making the big score. It's all about finding these mispriced assets, unloved assets that are out of the money based on the commodity price, taking a view on the commodity price, which is hard to do. You take that commodity price view, and when it comes your way, you can have a stock go from 0 to infinity, right? I mean, just at the drop of a hat. And then there are lots of examples, like look what's happened in lithium. Now lithium is sold off, but look what happened in lithium. Uranium. There's just countless stories where I think Ross Beatty famously put together all of those copper assets, which copper tape came his way 2 cycles ago. So I think it's a really interesting way to think about these. And importantly, you have to think about a lot of these exploration companies as options. And what do I mean? When you buy an option, you have theta, which is time decay. The time decay in a junior mining company is the cost to keep that company going and the cost to continue to drill. And as you get closer to the expiry of the option, it could become worthless, right? Well, the same thing in a junior mining company. As you get closer to the next capital age, you might get heavily diluted.
Yep.
And so, if you think about it like an option and you kind of appreciate that if you got the commodity call wrong, you got the asset call wrong, it might go to 0. If you start to kind of change your mentality and really appreciate that, it allows you, I think, to think about risk differently. And then you create a portfolio of options. And when an option hits, you can make a fortune on that, right? And I think that's how I think about these assets. Big, unloved, you're buying an option, the commodity comes your way, it's now in the money. And by the way, don't forget to sell. Like the biggest mistakes, not mistakes, but the things that I regret and when I look back the most are the ones I didn't sell. What's the old adage, about selling too soon, and you can make a small fortune selling too early or lose a large fortune selling too late. Yeah. At the end of the day, you can only make money by selling.
So another thing that I think is probably worth having a conversation about is all of the negativity that exists in junior mining towards CEOs of junior companies. I know that you've been a bit of a controversial figure.
Look, I've had some big wins and I've had some big losses.
Yeah.
And I can tell you I've gotten beaten up along the way and had some wins. It happens.
Do you think that the industry kind of does it to themselves, where people it's just not worth the reputational risk or all the negativity and criticism from the peanut gallery to actually take on the title of being a CEO, just because they're like the junior mining space, there's just so many trolls and so much negativity out there.
Yeah. Well, I think increasingly, I can tell you, just for some of the stuff I've invested in, it is increasingly challenging to find CEOs who want to be the CEO, because it's definitely going to be the case that you're going to take a lot of heat. And I think actually sometimes it's warranted for sure, but a lot of times it's unfounded because, at the end of the day, the vast majority of these companies live and die by the commodity price. Yeah. And I could show you chart after chart, pick your favorite winners and then overlap them with the commodity price. Yeah. And it's pretty damn binary. And and so I think what happens is, there's this kind of old adage about a fund manager. If you go and talk to a fund manager and you put them into a story and the story was a big success, that fund manager would be the smartest person in the room. Oh, I found this company and I was so smart and I got right. But if for whatever reason that company crashes, say uranium went down, it's the CEO's fault. And everyone on CEO.ca and all the other forums starts to pile in on them. And it's a little bit like, guys, come on, grow up. The reality is, guys, uranium went to 100 and whatever it went to, and it went all the way back down to 18. Yeah. And so I think because of that really massive, kind of powerful moves that happen in our space that don't necessarily happen in other space, which are largely driven by commodity prices, sometimes people kind of lose touch with reality on what is actually driving the price of a given stock.
Do you think that when you're looking at an asset, and I know we've talked about this, so I kind of know what your answer is, but for our audience, you're looking at investing in an asset. Are you trying to avoid assets that lean sort of exploration based? You want to find something that, because let's take an asset for a second. I'll make a fake one. A company that has, say, 100,000 meters drilling. There's been quite a bit of work done on it, and they kind of know sort of what the issues are. But you've had all that money spent, and there's a couple risks there of actually getting it to production that you go around and you talk to a bunch of geos, and they're going to probably scoff at you. Or you got a grassroots project, or that has some drilling on it, that merits, hey, this probably should have a little bit more exploration.
Yeah, I can tell you, I'm clear on this. So I'll give you an example. I recently invested in a company called Freeport Resources. They have one of the largest undeveloped copper projects. $300 million has been spent to date in Southeast Asia. And I don't know what the market cap is. It's probably $5 million. Yeah. To me, that has the most asymmetric optionality. Yeah. It could be zero, by the way. They could run out of money. P&G could blow up. It could go to zero. But to me, it could also be $300 million tomorrow. Yeah. When I hear about this grassroots exploration story, the only time I personally buy that story is in the heat of a bull market with every intention of trading it very quickly. Whereas these option stories, and there's lots of examples of them, like Uramin was a great one, they raised like $1.5 to $5 million. It sells for $2.5 billion 18 months later. To me, I'm happy to sit on those stories because there's inherently value in world-class assets, even if they're deemed at the time to be low grade or tricky.
Yeah, and then getting back to you mentioning theta earlier, when you're thinking about exploration and all the money that's going to have to be raised along the way, I'm not sure if we'd say that the theta is higher or lower. I guess it would be higher in those deals that are going to need so much more money to actually move forward.
And you just need luck. I mean, you have to like your witching stick, like in America when they're looking for water, like your divining stick. Yeah. I mean, like it's just luck. At the end of the day, searching for stuff, you're a treasure hunter. And I have respect for treasure hunters. I mean, these people go out, and there have been some great treasure hunters that have made magnificent discoveries. But let's talk about this for a second. Even Robert Friedland, the legend, right? Look at his copper discovery at Oyu Tolgoi. Actually, he didn't discover that. Like the Mongolians knew the copper was there for eons. He drilled it out. He maybe found the high grade. So, even that's a story about expanding on something that was there. But the people who are out wildcatting for gold, like, good on them when they find it. But for me, I only like that kind of a story when the market's pumping, when everything's working and you're trading it. But when I'm going to put in more money, more thought, it's going to be for these big kind of assets that are going to be built at some point in some cycle.
So you like the treasure hunters, but you like them even more when they've given up, thrown in the towel, and they're willing to hand over the asset over to you for nothing.
That's not, you know what? I'd rather take it on the cheap, that's for sure. And that's also why you need to kind of be a contrarian, right? Like you need to be looking at these assets and buying these assets when no one else is. And that also means you need to let them sit there potentially for years, potentially for 6 months, right? You don't know. I mean, and hopefully your investment is also guided by some sort of a thesis about why copper or why uranium or why nickel. Nickel's another one right now. It's completely unloved. I gave you an anecdote. Something like 75-80% of the global nickel supply is coming out of Indonesia now. One earthquake and the price of nickel doubles. Now you're going to have a hard time investing on that basis. But certainly if you liked some really large known deposit in Canada and it's trading at nothing right now, like that's a great option. And that's how you think about it. This is not a value investing sector in my view. These are value traps. It's full of value traps. This is a sector where you're investing in options and optionality. And I think when you take that framework and you think about it that way, it really kind of opens up the door for you to then assess your own risk and allocate your own capital in a way that maybe makes more sense.
Now, you recently did a piece on antimony. We're seeing antimony prices spike quite a bit. What's your read on it? Can you tell our audience a little bit about sort of your view?
Yeah, I mean, I just think it's interesting. The antimony market, I've kind of made a career a little bit out of some of these esoteric, Cobalt, antimony. What I would say is the cycles are shorter on these types of commodities. And so because they're such a small market, I'm talking now generally fluorspar, all these markets, because they're relatively small markets, and even when they have big changes in consumption profiles, it doesn't take a lot to rebalance those markets. And so as an investor, when you're thinking about these kind of esoteric minerals, like, fluorspar is really interesting right now. Antimony, when you're thinking about them, just recall that the cycle can be shorter because the capex can be lower, the deposits can be smaller, relative to say a copper cycle, where you can have a $5 billion copper project. And so that's something to kind of consider when you're thinking about, let's call it a non-core commodity, like as we said, a copper or even a nickel, where it's a multi-billion-dollar exercise.
Well, Anthony, I appreciate you taking the time to do this. For our audience who wants to get more of your commentary, where do they go to?
So theoregongroup.com, we kind of post anywhere between once and twice a month. If you want to see some of the transactions I've been involved in, you go to anthonymilewski.com. And always happy to answer questions on Twitter.
Awesome. Thanks for doing this,
Thanks for
Anthony.
having me. Appreciate it. Always great to have you on.
Appreciate your time.
Talk soon.